at George Washington University right now at the Elliott School of International Affairs. So, yes, so she is, and we have Jackie Walsh with us, which we'll reintroduce her today. Jackie is Tranquilli Financial Advisor, intern, also a George Washington, just soon to be graduate as of the end of December. So welcome again, Jackie. Thanks for joining us again. Great to have you here.
Thank you.
I will introduce Chris Cook. Chris is the owner of Beacon Capital Management. I've known Chris for, well, just about 10 years now. He and I have worked together. He is, I always call him the creator of the Beacon Capital Management methodology of the, as we call it, stop loss. You could call it risk mitigation methodology. Chris is a graduate of Bowling Green University. He is a math person. He's a math major, Chris. Correct me if I'm wrong on that, but I believe I have that correct, a math major. And he has applied his math skills to the theory of investing. And you've heard theory now twice, once in Maria. And Maria, by the way, goes by Quinn. So if you hear me call her Quinn, it is with affection and with respect. She goes by Quinn. So Chris and Maria, or Quinn, both math people, if you will, or theory people in investments. And I'll talk about that in a moment. And I did want to introduce again, Chris Taiwanik. You can see him on the screen right now. Chris is currently serving as Tranquilli Financial Advisor. Yes, for Tranquilli Financial Advisor Compliance Associate. And what that means to you is Chris is working with my business manager, Flory Cook, to reassess the processes of compliance within Tranquilli Financial Advisor. It's something that I take very, very seriously. I'm hopeful that that Chris, after I'll say rolling up his sleeves and digging into compliance, understands how important it is, but also understands how important it is to Tranquilli Financial Advisor. Chris is a graduate of Carnegie Mellon University, and we are proud to say that in just a short month or so, he will be joining PricewaterhouseCoopers as a consultant. Is that right, Chris?
Yep, that's correct.
All right, great. Well, thank you all for being here. And of course, everyone listening in, we're going to take about 40 minutes, maybe 45 minutes or so, have a good conversation about a number of different topics that we can lean on. Quinn through Vanguard. Now we do have Matt Nadler over there as well. And Matt, I'm just gonna ask you to wave if you don't mind. He is part of the Vanguard team joining us today. So we're going to talk about politics. We have to talk about COVID. It is 2020. Pardon me if you see me looking away. I'm reading notes. The markets overall. I'd like to focus on the U.S. market a little bit with Quinn and with Chris Cook. So I'm going to start it there, Quinn, if you don't mind. COVID. We'll start with the topic at hand, COVID. Plenty of conversation about the tests, plenty of conversation about the vaccines that look like they're out there. I would like, if you don't mind, two things. Give us an overall assessment within Vanguard, the conversations that you're having about the news that's coming out, which has been very positive, and no one's here to rain on that parade, that's for sure. We can all use the positive news. However, I would appreciate some insight as to the conversation of COVID and the vaccine as it applies within Vanguard and the approach to investing at this point.
Yes, happy to delve into it. It's, as you might imagine, a topic that's kind of interwoven in everything that we're doing at the moment in terms of the way that we're working, as we're all remote at this stage, in the way in which we're assessing our economic outlook, not only from March onwards to this point, but also in 2021 and going forward to the end of next year. In terms, as you said, it is good news. So, you know, the trial studies coming out of Pfizer and Moderna and applying for the authorization for use through the FDA is a very good thing. We're experiencing that in the context also of increasing cases. So when we are looking at our economic outlook and our kind of considerations to the market and our planning conversations that we're having right now, as I said, it's all within that lens of COVID. We are not, you know, we can't predict what the next few months will look like as we continue to weather this pandemic, while there is this massive, large scale project being undertaken to start getting vaccines into people's arms, which the best estimates I've seen coming from Pfizer and Moderna would be at some point, maybe in May or June, you would see kind of that threshold for 70% and kind of that herd immunity that they're looking to target. For the planning conversations we're having internal to the firm are, what are the broad implications for this on the economy? We don't necessarily see that affecting the markets, right? While we are seeing the virus vaccine news having a very positive effect on the markets in the last few weeks, we're not seeing that necessarily play out in the economy as much. We're still looking at large jobless claims. We're looking at slower growth. We're looking at segments of the country shutting down again. So our view is to kind of keep an eye on the progression of the virus, to see if there will be within this country additional efforts to perhaps not shut down segments of the economy again, but maybe more limit segments of the economy again, and the potential implications that would arise from having to do so. We can see that playing out in California right now, right? Los Angeles County and Santa Clara County have just put large kind of sweeping restrictions in place. We see that across the globe as well. But of course, it's really at the forefront of everything we do. And we're not doctors, right? We don't have doctors on staff as we're trying to make our best educated guesses on this, while kind of sourcing information like everyone else is around the globe.
Understood. And as I read in the disclosure, which I will let you all know that I'll read the disclosure for compliance purposes at the end of this conference call, because I was not recording as I read the first one. So I know compliance department, and of course we have Chris Taiwan here as part of compliance, wants to make sure that I read that disclosure on the recording. So no worries there. Chris, if I can jump over to you, as Quinn mentioned, we're stating the obvious, that we all are not doctors here, but accurately stating that we are all giving an educated guess as to what does this mean to the people that are on this call right now, to our other clients that will listen in later, to friends of clients that they'll send this video recording to. As a money manager, if you would share with us how you are viewing this right now within your office, and the tactics that you are taking as part of your work.
Sure. Yeah. Thanks, Lou. Much of what Quinn just went over, we're going through the same process and the same analysis, and really, quite frankly, coming to similar conclusions. So one of the things that I'm running into with a lot of clients is just understanding how the markets are different from the economy, or particularly what they're seeing in their local communities. When you're walking downtown, you're seeing, storefronts that are closed, restaurants that are running, maybe closed completely, or they're running about 20, 25% of capacity. And they don't understand how the market is just running like it is. And, one of the things we have to try to explain is that a stock market is always looking out into the future, somewhere between 6 and 12 months. And as Quinn mentioned, we're getting some really promising news on the vaccines, and some of the people on the front lines, they may be able to start getting some of the vaccines, late December, last week of December maybe, and then hopefully next year, that's when we do get that herd immunity, level of 60 to 70% of the population, and with that, we're not really changing a lot in our portfolios. As most of you know, we allocate equally across the entire economic spectrum. So we break the world into 11 sectors, of the world, whether it's technology or utilities or energy companies, things like that. And we just don't make a big bet on any of them. So recently, tech has obviously been really hot. It's benefited from, a lot of what's happened with this pandemic and the shutdowns. It's forced us to do things exactly like this. These Zoom meetings are happening on a pretty regular basis now for a lot of people. It's how we're communicating with our families, everything. It didn't exist at this level, 12 months ago. So companies like this are really benefiting. And it seems weird to say that anybody's benefiting in this particular period that we're in, but some companies are, and it's just the way it is. And these companies are driving the market too. You've got the 5 largest companies in the market. The S&P 500 control about 25%, of it. They're all tech, basically, with the exception of maybe Amazon, which a good chunk of its business is tech as well. So, with that, we're not really making any changes, equally allocating, fully diversified, but we do, as keep stop losses on our portfolios for when things do happen to turn down. We don't know when it'll happen. We don't know, if there's another shoe that's going to fall. We don't know how bad this thing could get before the vaccines really hit the population. There's lots of unknowns, really.
Okay, so Chris, I'm going to stop you there because we started off in reading Quinn's bio and also your starting of Beacon Capital Management and the theory of the loss, which yours is, and we have to say approximately 10%. It all depends on the timing of sale and everything else. But the theory being that we don't know market reactions, and look at 2020. I think if there was a year that gave us a perfect example of how to prepare for the thing that we never would have thought of, here it came and happened in 2020. I'd like to go over, if we could, just for a moment. You mentioned that you break the world down into 11 sectors. Just give us the quick on the thinking, how that protects, or I won't say the word protect. I'll say the word how that balances a client's portfolio and is a, if you will, natural defense against the markets dropping significantly by equally diversifying through the portfolio.
Sure. It's that old adage of diversification. Don't put all your eggs in one basket. So we diversify, all of our portfolios across these 11 sectors, so that each sector tends to react a little differently to the environment that's out there in the world, right? So we just talked about technology, and it's happened to benefit from these shutdowns, forcing people to use their products and use this technology to communicate and conduct business. So it's reacting much differently than say a consumer discretionary. So where the auto plants are shut down, or the planes aren't going in the air. So you've got different sectors are reacting to different things, very different ways. And we like to say that they're their own little mini economies, in and of themselves. So when you diversify across them, you don't expose yourself to any big bets or bubbles. Some could say right now that tech is kind of entering that phase of a bubble potentially, because it has run up this year, far ahead of the rest of the market. We just don't participate in that. Like I said, you've got 5 companies that are about 25% of the entire market. Compared to the S&P 500, you have 495 others, that just aren't carrying that much weight. So we don't want to make those bets. And we've seen this in the past. This isn't anything new to 2020, unfortunately. Back in 2000, tech grew to be about 33% of the market, overall. The bubble burst, and that left us for about 2.5 years of a bear market. 2007, 2008. We saw the same thing with financials and real estate. They grew to be about 1/3 of the market. The bubble eventually burst, and it creates this downdraft. So when we're equally allocated, we don't usually catch as much of the downside as more of a market cap weighted, which is what the market is. They just weight the big companies more. And 2020, for example, you mentioned a 10% marker, right? Well, on the S&P 500, we would have hit that 5-6 times this year. And in the equally allocated portfolio, we've really only hit it once. So that diversification, does give us a small buffer on the downside.
Okay, and I apologize for stepping away. I've got a couple. It's like I'm in charge of the board over here, and I have to make sure everything's running smoothly. Quinn, if I could ask you to comment on Vanguard's discussion of theory. So, and I'll if I can just wrap up Chris's comments with Tranquilli Financial Advisor in working with clients. I've looked for theories. We could all easily go out and build a 60-40 portfolio. It would be, it's just a standard issue, if you will. Moderate portfolio theory being when stocks are up, bonds may not be up as much. And then when stocks go down, bonds will increase or hold their value. That's not how I'm looking to do it. I'm looking for those interesting theories because I do believe that we can be what I like to call conservatively aggressive, meaning we have the stop loss behind us of a Beacon Capital Management. And I know we're not talking with them today, but the risk mitigation at Horizon Investments that we talked about last week. So Quinn, if I could ask you to bring us into the control room of Vanguard for a few minutes, talk about the theory that you're working with as part of investing at Vanguard, how you look at risk and the mitigating of that risk within the markets.
When it comes to our overall portfolio construction methodology within the firm, we do believe in broad diversification. Our approach is a little bit different. We tend to approach it from market capitalization, but we do believe in diversifying and having a healthy mix across stocks and bonds domestically and internationally. So if you take, for example, a classic example of one of our portfolio designs would say be a target retirement fund, where you will have an allocation depending on the risk tolerance of a client. It could be a 60-40, it could be a 70-30, what have you, and we'll appropriately allocate that 70% of the equity sleeve into domestic-based stocks and then international stocks to kind of round out that exposure. Our approach to international equity investing, we tend to have about 40% of our portfolios in that space, with the remainder 60% in the US markets. In terms of our international perspective for fixed income, we tend to have a little bit more of a home bias in our fixed income approach. So our fixed income portfolio weightings would be 70% domestic and 30% international. But one thing we do with our international fixed income is we hedge it back to the dollar, because when we take a look at fixed income, we look for diversification benefit and for ballast within that portfolio. So by hedging out the foreign currency exposure, we dampen a lot of the overall volatility that you would otherwise experience in the international issues of bonds. And by doing so, we dampen about 2/3 of that volatility, allowing that international bond component to act as a bond should. Again, diversification and ballast. So a slightly different approach, but one that we can, our products are able to be used in concert with a equal weight approach, but our in-house view is just market cap and providing as much of the market as possible in a cost-controlled way to allow for kind of a measure of control when we can't necessarily control what the market will do.
Of course, and thank you for qualifying it that way. Of course, none of us can. We're speaking the same different language, if you will, meaning we're all looking for ways to reduce. We want the exposure to what we consider the potential of the stock market. We're talking with a lot of people that could be retired or approaching retirement or have some personal reason for wanting to not experience. And I always go to the extreme because I think it's a great extreme to go to, which is not actually 2008. It's 2000 to 2002. That's the extreme of my lifetime, and I'm approaching 30 years of doing this work. 3 consecutive years of the market being down. The NASDAQ took off over 70% of its value during that period of time. We want to do all we can to avoid that experience, that's for sure. So Chris's methodology of equally weighting the market within and using Vanguard ETFs to do that with your theory attached to it, really, again, for Tranquilli Financial Advisor, that's why we present it. I do want to ask Chris Taiwanek if he has any questions on this, being a finance major at PricewaterhouseCoopers. I offered him the opportunity, and I'm going to jump in and ask a question about any of this.
Yeah, sure. So I actually would like to just change gears a little bit and ask you guys about taxes. Obviously, there's been a lot of speculation about what a potential new administration could do with taxes. And, Everyone's not sure about the Senate yet, what's going to happen with whether it'll be Republican or Democrat. So I'm curious what your guys' outlook is on that and how that might affect a potential client's portfolio that could be taking out money for retirement soon.
Quinn, why don't we start with you on that one?
I was wondering if you're going to flip a coin on that
Oh,
one.
no, I just flipped it. That's why I was looking down. I was like,
It's okay, I'll go first. So I like to caveat by saying that the policy proposal is not policy, right? There are a lot of moving pieces that go into the creation of policy and legislation. There is a lot of negotiation that will go into place before any changes would be affected on the tax code. One of those would be the question mark of what will happen with the balance of power within the Senate. So obviously that would have some kind of impact on whether or not we would see this Biden proposal go forward, either in part or in full. The proposal itself, you're looking at kind of a reconfiguration or a return to some of the prior tax legislation that existed, where the higher marginal tax bracket would increase. You would go back up to a 39.6%. So there would be a potential for income tax related planning considerations there. I think the biggest consideration that has been proposed, would be when it comes to capital gains. So right now you do have favorable treatment for long-term gains. The proposal would be to essentially create a standard income rate coming off of long-term capital gains that would be in congruence with the higher marginal tax bracket. There are a couple of other considerations and breakpoints in terms of income. I think we've all seen the commercial that if you're making less than $400,000, don't worry about this. But if you are making in excess of that, if you are looking at taxable income in excess of $1 million, there will be additional considerations there. I do also like to point out that, while we did see in 2017 some tax reform, that's not permanent tax reform. So a lot of those policies that were enacted actually are set to sunset in 2025. So there are a number of things that are moving pieces within tax consideration and any potential tax reform. But as I have said, and I continue to say again, policy is not legislation. Biden isn't going to assume office on the 20th, and then all of a sudden we have a new tax policy. There's a lot of work that has to be done before you would see any changes.
thank you, Quinn. And that has been a conversation that I've had with multiple clients, pre-election, post-election, taxes. What is it all? We would have to take I think all of us that are working with client assets would just take a good look at how are we accepting the selling of assets, or are we going to sell assets? What can we do to kind of restrict should this policy become the tax laws? Chris, do you have anything to add to that? I know that's not taxes aren't really your focus, but if you would, tax efficiency as it applies to Beacon Capital Management, talk about that just for a moment.
Yeah, it's definitely something that we're looking at, as well, because it will ultimately have an effect on the markets. I think I'm with Quinn that we don't know exactly what's going to happen yet. The Senate's still up in the air, but as a rule, I kind of think it's close enough at this point right now in the Senate, and there's a few, Democrats that are relatively moderate, on fiscal issues that, we're not going to see massive changes. So I don't think the Biden proposals will probably go through as they've been outlined, while he was campaigning. He may get, a few of them, through, but we don't know, which ones yet. The one, I'm with Quinn though, the one that kind of scares me a little bit is the capital gains rate. If that goes up significantly for, investors, that will have an effect on the stock market. And even if, you don't make $400,000 a year, you could be affected because, market values, may be affected on the stock market. We work with enough clients now, we're running, I guess, around 25,000 accounts or so. And we're already seeing tax gain harvesting. Usually this is the time of year where we see a lot of, losses, if you have particular securities or investments at losses being sold. So you can harvest those for the year to help out with your capital gains for 2020. This year, we're actually seeing the opposite. You know, it's the market is a great hedging mechanism. You know, overall, it knows how to hedge its bets, and investors are doing that. You know, like I said, we don't work with, you know, massive institutional clients out there. They're all, you know, fairly mainstream, you know, retirees for the most part, business owners, and they're hedging their bets. So they're cashing out now, locking in this 20% rate, and just seeing what's going to happen in 2021.
Okay, and with that, I'm going to jump in and say that I don't want my clients calling me to do that, because then the tax bill comes in April. So everybody that's here and listening later on, we'll work on that at a later date. I started off in the insurance business, which was defer. So we'll go with that as it applies to tax. But I really appreciate the insight, Chris. It's an excellent point, because it has an impact on the net return, and we all have to consider that as part of the work that we're performing on behalf of the clients. Quinn, Chris, really everyone on the call right now, I'm wondering, at your offices, are you making popcorn on a regular basis, watching for the results in Georgia, just ready for the like watching a movie and waiting for it to unfold? How much interest is there? Obviously, it's an important election. It's so important. Yeah, I can't help but think of there was a movie, a Kevin Costner movie, if you recall, Swing Vote, and his vote decided the election. So how often are you checking in on this? Is it having an impact day by day, Quinn, as to decisions that are being made? Is that possible that it would have that kind of impact?
So I would say corporate wise, no. Right. Elections are important, but investments matter more. And so the outcome of an election isn't going to change our investment philosophy, our investment approach, et cetera. You did mention GW. Obviously, as a DC policy wonk, having lived in the District of Columbia for over a decade of my life, I pay attention and I make the popcorn at home and watch, returns come in and everything. I'm all about it. But when it comes to, our corporate outlook, the elections happen every 4 years, right? The markets usually price that in to a certain extent. Policies change, people change, but that's not going to change our overall approach.
Excellent. Chris, of course, it's not changing your overall approach. And for everyone listening, part of what I respect about Chris's work, he has his theory. He sticks with his theory. I obviously use Chris in most cases, not all cases, in conjunction with other investment firms that have their own theory of work. And in marrying those together, I believe that we really come to a good place with theories working on client accounts. I do want to put Jackie Walsh on the spot, being, of course, a GW student and ready to graduate. Make sure she doesn't have any questions for us at this point as well, because Jackie's been our communications intern, and unfortunately she will be moving on at the end of the year. I've tried to tether myself to her expert work, but she says no, she's on to bigger and better things, and I'm rooting for her, of course. Jackie, any questions for Quinn or Chris?
I don't have one right now. I'm trying to think.
Come on, give him a politics question. You are at GW. You're in the epicenter of all of this.
I know. I feel like I'm disappointing Quinn, because she said that she's really politically driven, and I have kind of missed that boat at GW. But I'm trying to think. Let me see.
You go ahead.
No, go ahead.
Or you can give us one right now.
Okay, give me a moment so I can think of something good.
You got it. All right. That's it. So we keep it real here, and that's I love to give the people working with Tranquilli Financial Advisor their voice as well. But I'm going to just I'm reading off my list because it's something that I think is really important. I read in the New York Times yesterday about the European Union and reaching out, if you will, to say we'd like to the U.S. to deal with, and those are not my words, those are the words in the article, deal with China. Chris, I'm going to start with you. if you would, give us some thoughts on what does that mean to investors? That to me, that sounds like the next headline that we'll be reading a whole lot about. The European Union at least sending signals that they'd like to work with the U.S. To deal with China. What does that mean to you?
Yeah, I think it means potential volatility, honestly. When I'm looking at it, through history, we saw what happened when Trump, took his approach with tariffs against China, things like that. So, if you could form a cohesive group that goes after China, on a unified, manner, it could be even stronger. You could really, put some pressure on China. And, here in the United States, whether we like it or not, we rely on them a lot for manufacturing products. And now it's become a huge market for many of our companies to sell product to. So, we saw that before. The last time the tariffs came through, there was pretty high volatility. And I don't see a reason why that wouldn't happen again, depending on, their approach, the policies. Now, we don't know exactly what's going to happen, as Quinn's, stated a few times, but we're not anticipating the, I guess, knee-jerk policies that we've become accustomed to for the last 4 years. So they should be, at least slightly more telegraphed. And I think that the market will probably digest that a little bit better. They may not like the policies any better, but they know it's coming. The markets just don't like to be surprised. And that should be, watered down a bit.
Okay, and Quinn, if I can ask you to comment, I have to imagine there are internal discussions immediately when something like that is the subject is even broached in one article within the New York Times. Obviously, a loud voice, if you will, on politics. What do the discussions become within Vanguard? Again, keeping in mind the overall philosophy doesn't change, but the day-to-day tactics, do they change?
I don't necessarily think that our day-to-day tactics change. Obviously, when we take a look at our investment strategy group, which would be kind of the forefront of our research across the globe when it comes to markets, when it comes to market movement, we have a group that is set up in Southeast Asia and is working out of China directly. And so, nothing changes necessarily for us day to day. I think that when looking at, geopolitical structures and alliances and the like, I don't anticipate that there would be an overnight change necessarily. I think that the United States is going to find itself in a position where we are going to start to be, renegotiate and reapproaching a number of our traditional alliances as well. So I think that there will probably be, discussions very broadly across the European Union, not just necessarily as it pertains to China, right? One of the largest geopolitical powers and the largest economies in the globe. But I think that we will see a different way of politics, right? As Chris said, it won't be these knee-jerk type of reactions. So the market might, adapt to it a little bit more smoothly, and we won't see kind of the spikes that we have seen over the last few years. But in terms of our approach and the way in which we're conducting business, it's not going to change our long-term philosophy, and it's not going to change our day-to-day approach either from anything that I've heard or I've read.
Okay, great. Thank you. Jackie, I think you've got one for us now. Is that correct?
Yes, I do.
All right, go ahead.
Bear with me. This could be a very stupid question, but I'm curious in terms of speaking about China and its impact on the market. Do you think that in terms of other foreign countries, that's the country that has the most impact on the US right now in terms of market changes, or is there any other entities that equal that, if that makes sense?
Quinn, please.
I would say individual country, yes. China's the second largest economy in the globe in terms of population, in terms of economic growth. I believe that they actually will be positive in their economic growth at the end of this year, and they're the only country across the globe that we project will be so. So they are definitely a powerhouse. When you look across regional alliances. So if you look at the collective of the European Union, if you take into account trade agreements that exist, then you kind of go into a little bit more of a geopolitical balance. But as a single country, yes, China is, they're growing at a very exponential rate. So in terms of economic impact, definitely would consider China. It used to be that there were the BRICS, right? So you had Brazil, you had Russia, you had India, you had China. But China seems their economic output has been, very tremendous, I would say, even in the post-COVID realm.
Okay, and we'll move off of China now. Great question, Jackie, as always. And that I want to bring it home. Let's bring it back to the U.S. From the standpoint of the view of the economy. And Quinn, I'll start with you. Your Vanguard's view of the economy moving forward. You mentioned it in the opening. If you could expand on it just a little bit, what we obviously get all qualifiers on the table. Don't know what COVID brings. Let's make the somewhat reasonable assumption that a vaccine gets out soon enough. I do want to just state what I did last week, which is if we've had about 11.5 to 12 million cases and we have 330 or so million people in the US, 320 million is a long way to go for the herd immunity to take place. So I'm not trying to be negative on it, as I said, but I think part of my work for the people that I do the work for is to say, look, it's really good. The headlines say Moderna and everyone's, the 8 different countries working on a vaccine, but we have 320 odd million people to go. What does that mean internally for the economy? How does Vanguard view that? How do you approach that investment wise?
So very, very well teed up, because we actually have our new economic outlook for 2021 being released next week. But I do have some
I'll
revised.
take a copy. Thanks very much.
I will make sure that we get it over to you immediately.
Good. Thank you.
As of today, though, we do have some revised numbers. COVID, there have been some interesting silver linings with COVID. We came into this year with a very highly valued, arguably overvalued equity market. So coming into 2020, our outlook for the 10-year forward-looking equity market in the United States was about 5.5% expected return over 10 years. With COVID and some of the volatility that we saw in the market, valuations kind of coming into a little bit more of a realistic sphere, we reconfigured our 10-year forward-looking evaluation for the U.S. equity market and had it at about a little bit more than 10%. Coming into the end of the year with some of kind of the settling around COVID, around, what the initial return to work and the initial return to employment looked like after the first wave and kind of us cresting into a second wave, we have tempered down our expectation a little bit more. So, our U.S. equity outlook right now, I believe, is about 3.7 to 5.7. Sorry, I misspoke earlier. We had revised mid-year to about 7% on the equity market in the United States. It's 10% globally. But again, we've revised that down a little bit. In terms of the ag, looking at the bond market broadly, you're looking at about 0.7 to 1.7%, kind of a rather muted expectation there, but not terribly dissimilar from what it would have been going into the beginning of this year. As I keep using this idea of 10-year forward looking, because our outlook is not, it's not going to be the daily outlook on the market, right? It's going to be a longer term expected range of returns across the market. We do tend to use that 10-year range mark, and we do so deliberately, right? Because that's typically how investors are going to be investing over the course of the long term, not by the quarter or by the year, unless it's with specific kind of considerations for immediate income needs. But clients tend to stay invested. But that's really we're slightly revised down going into 2021. But again, those numbers will be fully refreshed, and our economic outlook will be available as of, I believe, December 8th. I'll wait with my popcorn for that. Okay. That actually
puts us in a great place to wrap up. And I do want to thank everyone. Jackie Walsh, Quinn, thank you so much for your insight. Chris, as always, I appreciate you, and I want to get another word out of you before we go here. And of course, Chris Taiwanik, his excellent work. Matt Nadler for being here. Josh Wingard, I see him on here as well, so thank you. And of course, clients that are joining us live, those who will watch afterward, which you don't even have to watch, you can just listen. You can, how's this, make breakfast, make dinner, and listen to Tranquilli and all his friends. So in wrapping it up, I would, because this was by design, if you will. Chris and his work for clients that he works with through Tranquilli Financial Advisor, the intent is the use of risk mitigation, we would call it, day-to-day stop loss within the portfolios, associating with Vanguard. Why it's so important. Chris is focused on cost. He's also focused on the ability to trade his portfolios when that time comes. Vanguard being, from my vantage point, a really excellent partner to do that kind of work with Chris. So Chris, if I can just ask you to just give me if you will, why would you have a risk mitigation? And we did this in 2019 with no idea that COVID was coming in 2020, of course. We had a conversation that if I'll remind everyone, in 2019, the stock market was up, let's say, above 20% on the S&P 500. It looked like it was the easiest thing in the world to do, was invest your money, and you just got more money back. Not the way it works, and that's the if you will, the theme of what I'm getting at. Chris, give us, if you will, the reason why maintaining stop loss still makes sense, even with a market that looks like it's always going to go up.
Yeah, because things like 2020 happen. Usually what makes the market go down in a big way is usually something we don't see. It's some kind of a surprise. It just doesn't, it comes out of left field. Even in 2008 with the financial crisis, we had no idea, honestly, how much money was wrapped up in synthetic type investments centered around mortgages and in equity in homes. It was insane, really. And when we finally started to figure it out, it unraveled in a hurry. And here we come to 2020. I've built a lot of strategies over the years. I have never built one for a worldwide shutdown. It's just not on my board. So the stop loss happened to be built for something like this, but I can tell you it wasn't designed for it. And that's why we do it. And it's really, good old fashioned math. Losses are more powerful than gains. A lot of your clients have heard me say that a million times. It takes a lot more to get back to break even than it does for the loss. So anything that we can do to limit those losses and smooth that ride out so clients can stay invested, in a strategy is a good thing. Then we're doing our job. We found, a lot of, folks, back in February and March, they went pure panic mode. And we saw it in the numbers across the industry. There are just massive outflows, from the equity market. And if they would have held on, they'd be okay right now. But honestly, not many did. It was by far the other direction. And those clients, for the most part, or investors, I should say, never got back in. There's two decisions that have to be made when you decide to sell. When are you going to sell, and then when are you going to get back in? Where I like a mechanical approach. We know, before we ever start investing, when we're going to sell, when we're going to buy. And it's not always right. It certainly isn't, but it's right more than it's wrong. And in the end, you'll be more consistent. And that's the key to success usually with investing.
Excellent. And I'm going to throw it back to Quinn, ask you to wrap it up for us. Quinn, any last words for clients that are here now or joining us later on?
I remember hearing a quote at kind of the beginning of all of the volatility that we experienced in March. And, the time right now is to do nothing, right? So make sure that you're, unless the goal changes, The investment plan should not. And so, I think that we can say that we will experience volatility again, right? It does not exist in a single bubble or a single vacuum, and just be prepared to weather that. No one saw this coming. And I think that, saying that you were planning in 2019 and having conversations about risk mitigation and then a pandemic happening in 2020, it's been a year of the unforeseen. And I think it's, embracing that and don't abandon the plan. Just stay the course with it.
Well stated, and thank you all. So I have to take just a moment. I am going to share my screen again and read the very important disclosure. You're all welcome to mute yourself, but I do want to make sure I get back to this, and I have to be sure for compliance purposes it's here. So pardon me. Today's conversation is not guaranteed. Past experience is not indicative of future results. Clients may lose money. This webinar was created December 1st of 2020 and is provided by Tranquilli Financial Advisor, LLC, for educational use only. The opinions expressed herein that have been expressed are as of today's date of this report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or the offer to sell any product. Tranquilli Financial Advisor, Beacon Capital Management, and Vanguard Investments reserve the right to modify their current investment strategies and techniques based on the changing market dynamics or client. There is no guarantee that their assessment of investments will be accurate. The discussion, outlooks, and the viewpoints featured are not intended to be investment advice and do not take into account the specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort level and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Investment advisory services are offered through Tranquilli Financial Advisor, LLC, a registered investment advisor. So with that, I hope everyone had a very, very nice Thanksgiving. I thank you all for being here again. Here's to a wonderful new year. Always looking forward to them. To quote my dad, I always, every day is a good day. Some are just better than others. So let's have it. So thank you all again. Quinn, thanks. All the Chris's, Matt, Jackie, thanks again. You all have a great day.